We've seen a very nice rally in the US markets over the past couple of weeks. That broke last night slightly. Our markets, though, and other emerging markets appear to have broken trend with developed markets like the United States. Does this really illustrate the pullout we're seeing from emerging markets into developed markets at this stage?
Absolutely, Stephen. It's been a trend that we've seen developing literally since the end of last year. Firstly, everybody's excited about the growth prospects for emerging markets. If you look at the newest IMF projections, they now reckon that growth for this year for the emerging markets as a whole, 6.5% for 2011, 2.5% for developed markets, 4.4% for the world as a whole. So yes, it looks like the growth is still in the emerging markets. The problem is that inflation is starting to increase in the emerging markets a bit quicker than elsewhere. That has led many of the emerging markets to start hiking rates already, and slowly but surely the investment background has deteriorated somewhat in the investments in the emerging market space, so much so that quite a bit of the money has started flowing out of emerging markets. And yes, we are now seeing developed markets, the prospects for those looking better from an investment perspective. Emerging markets looking pretty expensive relatively to developed markets.
Do you see this as a temporary trend? You've pointed out the growth rates we're expecting from emerging markets, 6.5%, South Africa lagging that substantially though. As inflation and interest rates start ticking up in those developed markets, would you see a shift perhaps back to emerging markets? We've already seen in the UK that's inflation rate pretty close to 4%, some saying it could get to 5% soon.
You're 100% correct that I think the longer term theme is still for investors to look for growth and some earnings pickup in the emerging markets. The only problem is that these things work in cycles, and it seems like the short-term cycle now at least is maybe to go back and wait in the developed markets first. As I mentioned, the inflation pressure is a bit more in the emerging markets right now. We see that the transmission mechanism of inflation globally happens faster in the emerging markets as energy and food prices make up a much bigger portion of the basket of consumers in the emerging markets than in developed markets. So for the time being, we don't see any pressure of inflation in the developed markets, and hence interest rate rises seem to be quite a bit away still in the developed markets, and hence the preference for developed market equities right now.
Well, you mentioned that food and energy inflation. We've seen commodity prices rising very nicely over the past few weeks. Copper above $10,000, hitting all-time highs. Tin also hitting all-time highs. We have oil above $100 a barrel. Do you think we're seeing a picture that's going to sustain those commodity prices at these levels? Do you think the China growth is the story that's going to keep these prices there?
Yes, Stephen, growth has probably surprised all of us on the upside. We've now definitely seen a V-shaped recovery. And as long as 4.5% global growth continues, 6.5% in emerging markets, 8% plus in China, the pressure on the commodities are going to stay. So in the next 2-3 years, there's nothing on the horizon that suggests that commodity prices, especially base metals, are going to come off sharply. We've seen some pressure in the soft commodities recently due to some peculiar weather patterns. Those are probably more cyclical. But anyhow, the picture for commodities still looks very positive for the near term. And hence, yes, that inflation on energy will still continue.
What are the risks to this V-shaped recovery, though?
The risks obviously is in Europe. There's still a lot of problems there. We have some sovereign debt issues there which need to be resolved, which we don't know exactly how it's going to happen. The other risks are geopolitical, which you definitely can't predict. And then the more cyclical thing that we need to get around is that up until now, growth has been induced by governments supporting the economies, and we've seen a synchronized growth pattern all over the world where all countries have supported their markets, providing liquidity and supporting the markets and inducing the growth, what we've now seen. What we need is that growth switches over to be a consumer-led growth, and that'll be a lot more sustainable. The risk is that the consumer doesn't take up the slack, and then we might see some of the growth pulling back, and that's the risk that I see in the future.
What signs of that consumer-led growth are you seeing, particularly in the United States, which remains the world's biggest economy?
Well, unfortunately, the unemployment figure, which seems to be the number that everybody looks at as the absolute pulse of the US economy, is still stubbornly high. It's just come down from 9.5% to 9%. So that number is still high, but we've seen in every recovery recently that employment growth has been slower and slower to pick up, purely because labor has become so globalized and international. So the pickup is pretty slow. However, I think that on everything that we've looked at, the retail sales, etc., all of those numbers have improved quite a bit. The housing market in the US, of course, the important one to watch. Yes, those prices are still low. There's still a lot of stock around, but it seems like housing prices at least have stabilized, and that should give the consumer some comfort. The consumer is in a lot better position in the US thanks to much lower debt burdens that they now have, and the interest service burden is a lot lower due to very low interest rates. So the picture for the US consumer is improving drastically.
George, take us through the US yield curve. I know that 10-year yields have surged to 9-month highs. Take us through the yield curve and what that tells us about the inflation and the interest rate outlook in the US.
The US yield curve is definitely telling us that we are seeing more growth than what we originally anticipated. The US yield curve is already pricing in a 0.25% hike by the end of 2011. I think that's pretty aggressive. I think it's maybe a touch negative. The markets have been spooked by the recent strength in growth numbers. The PMI is all coming out very nice. And hence the bond markets have been scared a little bit. So the bond markets, the yield curves have been steepening due to some inflation concerns, some robust growth numbers coming out, and obviously monster supply still coming to the market. So the yield curve's probably a touch steep right now. They're at historical levels of steepness. So those things are telling us that the economy is growing nicely.
Perhaps tell us how you would position a portfolio at this stage. I see you would still like to maintain equity exposure with a bias towards international equity. So perhaps on a portfolio, what sort of split would you take offshore? Where would you be putting that? And the equity exposure locally, where would you be allocating that?
You know, at Citadel, we try and pretend that we're sitting on top of the world and looking at the entire world as an investable universe. Only then do we have to come back to the reality of the practicality that our investors are South African investors, and there are some constraints to that. But if you think in an unconstrained environment, right now you would place most of your money in developed markets, more so than in emerging markets. We have spoken about that. As a South African investor, though, we would suggest that you place the maximum possible out there. Some of our analysis have indicated anything between 55% and 70% of your investments should be international at this point in time. And that's not necessarily a reflection on the currency. We're not taking a rand view here, and that statement's not based on the rand or its prospects at all. It is merely about the relative valuation levels of the different asset classes, with bond rates still very low. Yes, bond yields have picked up quite a bit, but in historic terms and versus our peers, they're still relatively low. So equity is still the preferred asset class. So you ask about structuring a portfolio, equity biased, developed markets, and as much international as you could.